Good afternoon, friends. My name is Sanjay Vasudeva, and I'm here to speak to you on Essay 240, Auditors' Responsibilities Relating to Fraud in an Audit of Financial Statements. So this standard has always been very important, but in the context of whatever are the events happening these days, it is assumed all the more significant. So we will see what the standard covers. The scope and effective date. You see, it's effective currently. What are the objectives of the auditor? Certain definitions. From the requirements section, we'll talk about professional skepticism, discussion amongst the engagement team, risk assessment procedures, identification and assessment of risk, responses to assess risk, evaluation of audit evidence, when auditor is unable to continue the engagement, management representations, communication with those charged with governance and management, and communication to regulatory and enforcement authorities. And also what documentation you need to obtain. Then the standard also has various appendices and application and other material, which I suggest you should go through to understand this standard much better. So the scope of the standard is that it deals with the auditor's responsibilities relating to fraud in an audit of financial statements. And it actually expands on SA 315 and 330 in terms of relation to risk of material misstatements due to fraud. So we all know that misstatements can arise because of errors of fraud. The distinction is that fraud is intentional and errors could be unintentional. So this standard actually talks more about the intentional mistake. So before we go on to understanding about fraud, it's also important to understand the fraud triangle. So these are some of the fraud risk factors of the fraud triangle. So there's always some incentive or pressure on, so depending on whether it's the employees or the management, there is some incentive or pressure to do a fraud. There is an opportunity, and then there is an ability to rationalize also. So what is fraud? Fraud could be theft of assets, it's misappropriation of assets, could be fraudulent financial reporting. In the case of employees, it could be because the level of oversight is not there, there could be some pressures, financial pressures. In the case of management, there could be incentive to show better results. So these are some of the incentives or pressures which will lead to frauds. And along with whatever I had mentioned, fraud also includes intentional omission of amounts and disclosures. We also need to understand as we go along what is the responsibility of the auditor and the responsibility of management and those charged with governance. So the responsibility for fraud prevention and detection, and this is very important, rests with those charged with governance. Because those charged with governance need to understand that they need to have an oversight of management policies. They need to consider potential for management override of controls. But this is an inherent risk. And also consider potential for management's influence on financial reporting. So this is something which those charged with governance, which is audit committees and board, need to understand, and they need to design policies to ensure that these are mitigated. And as far as management is concerned, their responsibility is also laid down. So they are responsible to establish these policies and to ensure that they are properly followed. And they're also responsible for emphasizing on ethics and honesty. So you know that the tone at the top is what sets everything. So that's the most important thing. Then now let's see what's the responsibility of the auditor. So in line with SA 200, which lays down that the responsibility of the auditor is to obtain reasonable assurance that financial statements are free of material mistakes. Specifically with regard to fraud, because there are inherent limitations on audit, And fraud is designed in a way in which it can be deliberately concealed, so it's difficult to detect. So that's the difference between fraud and the unintentional error. That fraud is designed to escape attention. So the auditor needs to be aware of that when you're conducting the audit, that this is something which can occur or will occur, and so you need to design your audit procedures around it. So I think that those are things which the auditor needs to understand, and thereby the role of professional skepticism is all the more important, because professional skepticism allows you to have a questioning mind. So the auditor needs to maintain a professional skepticism throughout the audit, and knowing well that there would be fraud risk factors which are there, and how to mitigate them. Which means that you don't accept things as they are, and you have to have a questioning mind. So coming to what is the objective, auditor's objectives is in specifically to this standard identify and assess the risk of material misstatements due to fraud, obtain sufficient appropriate audit evidence, that is what SAE means about assess risk, and then respond appropriately to identified and suspected fraud. So in line with what we do as far as 300 and 315 are concerned, we will apply that specifically to SA 240. So looking at some definitions, the most important definition which is given in the standard about fraud. So fraud is an intentional act by one or more individuals amongst management or those charged with governance, employees or third party, involving the use of deception to obtain an unjust or illegal advantage. Now this is different from the definition which is there in the Companies Act, section 447, which is much wider. But since we have confined ourselves to this standard, I'll only focus on this definition. So it's an intentional act. That is why the errors which will come up are also intended. It could be any one or more persons, could be management, those charged with governance, employees, or even third parties, could be vendors or etc., who are carrying this out. And so what are the fraud risk factors? And these are the fraud risk factors which I just mentioned. The fraud risk factors indicate an incentive or pressure to commit fraud, and these provide an opportunity for fraud. So there could be lax internal controls which could lead management to override these controls or to achieve objectives to show higher earnings, to depress expenditure, or employees to give claims which are not genuine, and to take reimbursements against that. So these go back to what I mentioned initially, the fraud triangle. So there's an opportunity, there is incentive, and then you can also rationalize. So these are important as far as the standard is concerned. As I mentioned, professional skepticism is very important, and knowing that the fraud risk factors are going to be there, auditor always needs to have a questioning mind. And so which means that whether the information or evidence which has been given, is there a possibility that there is a material misstatement due to fraud? Don't take the client integrity and honesty for granted. Don't just believe whatever information is given, even if that has been there in the past. You need to take each quarter, each year as a different one, and to assess that again. And documents which are accepted may not be genuine. So there may be, if there are no contrary indications. But if there are contrary indications, then you may confirm from a third party. Auditors are not supposed to be expert in reading legal language. They are not on interpretation. But if you're in doubt, then you need to engage an expert to assess the authenticity. And supposing the inquiries which you make and the response which you get is inconsistent, then you should investigate further. So this is what professional skepticism is, that don't accept anything on face value. You need to go behind, you need to have a questioning mind. So once we've established that we will have professional skepticism, during the planning stage, it's important that the fraud risk factors are discussed with the engagement team entirely. So it should not be confined only to the senior members or the partners. This entire thing has to be discussed between the engagement team. And which is that what is the susceptibility of the financial statements to material misstatements due to fraud? How and where they can occur? Is it revenue? Could it be inventory? Could it be fixed assets? Is it in terms of contracts? So these are things which we discussed to be discussed within the engagement team. And again, this discussion has to take place even if the auditor believes that management or those charged with governance are honest. So this is a given that we will do as an auditor. You need to have this discussion with the engagement. What are the benefits of this discussion? One, it is not confined only to one person. So the benefit of discussion emerges because experienced team members can speak from their experience. So they may have worked in a particular industry or may have worked with that client, and they can bring forth their experience to share that, okay, these are areas, again, could be revenue, could be impairment, investments, subsidiaries, anything where there could be a risk. Auditor can then formulate, the audit team can then formulate their response to such susceptibility and also decide which are the team members which need to focus on which areas. And supposing there are allegations of fraud which come to light, either during your audit, there could be whistleblowers, there could be anonymous complaints, how to deal with it. So it's very important that this entire discussion takes place, and it's a fruitful discussion. Next, we go ahead to see, once the discussion has taken place, what are the risk assessment procedures, the RAPs which has been mentioned, with regard to fraud. What is the auditor going to do? So just to go back, you're going to first identify or risk assess the risk, then you will respond to the risk. So right now we are at the stage where we are assessing the risk. So this section will cover about what areas to be covered as far as management and others within the entity, those charged with governance. Are there any unusual or unexpected relationships? Where can we learn from some other information? And how do we evaluate the fraud risk factor? So the first stage is to have inquiries of management. So because the management is the one which is responsible for maintaining those policies. So you need to inquire from the management that what is the nature and extent and frequency of assessment? How often do they assess? Are there fraud which have taken place at different locations or in areas? Does it mean that they are going to assess what is the frequency change which they are going to make? What are the relevant controls for prevention and detection? These could be manual controls, these could be automated controls. Have they understood this? And what is it that they have set in place? What is the process of identifying and responding to a fraud risk? Are there any specific risks identified? For instance, revenue is a given that there could be a risk of fraud and revenue. So what is it that the management has done? Do they communicate with those charged with governance, which are audit committees and the board? And how does the communication to employees, is there a code of conduct, an ethics policy, best practices, which is communicating to employees that they need to really ensure that best practice and ethical practices are followed? So this is something which you need to inquire from the manager. And again, in situations where you suspect management fraud, then you also need to inquire from personnel below the management in terms of whether they suspect any other aspects of fraud which may be happening in the company and the management may be aware or may be involved. Inquiries of internal auditor, whether during the internal audit scope they have covered the fraud risk assessment, whether they have come across any fraud, How have they dealt with it? Have they communicated to management or those charged with governance? So these are matters which one needs to inquire. Again, it's important also to communicate with those charged with governance, which are audit committees and board, in terms of what is their process for identifying and responding to fraud. Because ultimately they are responsible for ensuring that there is adequate oversight and frauds don't occur, or if they occur, they are detected. And what are the internal controls which are set up for mitigating those risks? And one can also, as an auditor, also ask that what are there any actuals if suspected frauds are there? How have those been dealt with? Or are those charged with governance aware of any such frauds taking place or having taken place? So this will help in terms of the auditor then, forming a better understanding about these factors. So, during a planning process, you would also, as an auditor, carry out an analytical review, and you come across any unusual or unexpected relationships. For instance, your revenue is increasing, but your quantitative sales is not increasing. There is a difference between your employee cost and the number of employees. Huge difference. The employee cost has gone up, but the number of employees has not gone up. Or there are other relationships between financial and non-financial factors. Would they indicate a risk of a material misstatement due to fraud? The auditor needs to determine that. So there could be certain other information which the auditor can look at to identify if there are risk of fraud, which is your earlier experience with this engagement during a discussion with the engagement team. What was the information which you received when you accepted the client or on an ongoing retention process? Are there some indications of fraud risk factors in the company, or because of the industry situation? These are matters which will help the auditor to carry out the risk assessment process in a much better manner.